Today we are discussing the value of advice. My name is Sarah McGinniss and I'm a financial advisor based out of our Madison, Wisconsin office. And joining me today is fellow financial advisor Jake Loescher, who is based out of our Rockford, Illinois office.
So great. So this is a layout of today's agenda. I will be reviewing the overall advisory landscape and some of the initial considerations of how to value a financial advisor. And then we will both tackle some of those unique considerations around advisor value. While much has been made about the value of financial advice in the past 10 years, we really felt it was important to address what services advisors actually provide and how exactly different advisors are compensated. This will then lead to a better understanding of value and helping to determine if you're getting enough value relative to the fees you pay. So let's dig into today's landscape of financial service professionals. So to help organize these conversations, we've laid out different advisory types along the top columns, everything from a standard brokerage arrangement on the far right to the registered investment advisor on the left. Then along the side rows are key considerations to help categorize and evaluate service. And I'd like to take just a few moments to define these. First, on the top, fiduciary standard. Now, fiduciary is a legal term which defines whether an advisor works in your best interests and is legally held liable for giving advice in this manner. Financial service professionals are regulated through different governing bodies. For example, there are three main governing bodies. One of them is the Financial Industry Regulatory Authority, otherwise known as FINRA, the Securities and Exchange Commission, or the SEC, and the Office of the Comptroller of the Currency, or the OCC. Now, the SEC and the OCC require fiduciary advice, while FINRA only requires a suitability standard. This means that advice doesn't necessarily have to be in your best interest. It only needs to be suitable and therefore can't hurt you. Second, types of compensation. Financial advisors can be paid in many ways. Fee only and direct from clients, indirect from revenue sharing or kickbacks, commissions based on product sales. Those are all good examples in this category. And knowing how your advisor is paid is obviously critical for you in measuring the value of advice that you receive. And as you might imagine, both revenue sharing and commissions can generate significant conflicts of interest. Third, product versus advisory focus. So what exactly are you buying? There's a difference between products and advice. Simply stated, a product might be a single investment, in your investment portfolio, whereas advice is more of a robust discussion around what exactly should be in your portfolio. An allocation, for example, how much stocks versus bonds. Fourth and finally, the internal investment costs. Financial services is rife with disclosures and unfortunately very little transparency. Usually your advisor has both visible and invisible costs. Now, depending on the type of advisor you hire, the invisible costs can be both larger or smaller, and they're often tucked into the individual investments within your portfolio. So a careful review of these details is often paramount. So from right to left, let's start breaking down the different service offerings. Independent brokerage companies exist all over the country and often have custom tailored firm names that are supported by larger national entities. Typically, they don't serve in a fiduciary role, though sometimes they can. And while they balance delivering both product and service, they typically receive compensation from many places, which makes it difficult to identify a true cost. And finally, internal investment costs can be highly variable. National wirehouses are typically the most expensive and least favorable for consumers, generally not working in a fiduciary capacity and often being very product focused. Bank trust companies, on the other hand, often regulated through the OCC, are held to a fiduciary standard, but it doesn't always mean that they are free from intrabank revenue sharing arrangements. There's usually a decent balance between the motivations of advice and products being delivered, however, to the actual end client. And finally, RIAs. Regulated through the Securities and Exchange Commission, they're held to a fiduciary standard going through the Investment Advisors Act of 1940. RIAs are typically fee only, meaning only paid by clients, typically advice heavy instead of product focused because they're only paid by clients, and usually make significant efforts to reduce the invisible cost clients ultimately pay for any of the individual investments or solutions that are offered. So I hope this gives you a good landscape of financial services professionals that actually exist in our environment, as it's gotten more and more complex over the last 50 years of time. So now that we have a firm handle on the types of wealth management service offerings available, let's dig into how exactly we value an advisor. Now, while Savant can't explicitly identify exactly how much value any individual advisor can offer, there have been numerous industry-ranging studies on the value of financial advice. The first major study was done, interestingly enough, by the largest mutual fund manufacturer in the country, Vanguard. This was back in 2014. They actually renewed this study in 2019, and they joined other large-scale academic studies for both Morningstar and Russell in the past 4 years. Now, this topic's gained significant attention nationally, and it's helped raise that level of individual investor knowledge, which is good because it leads to better buying decisions for consumers. It's also narrowed the field of qualified advisors because obviously the stakes are a lot higher. And it's increased those expectations on the advisors in the industry that are still there to provide those higher levels of service. So this graphic is broken down into the many quantifiable, more tangible elements of measuring an advisor's value. There's portfolio construction. There's also planning and implementation, and also at the bottom, behavioral coaching. Each one of these areas is subtotaled into an approximate value. And in total, these three industry leaders would actually contend an advisor is worth anywhere between 2 and nearly 5% per year of value. Again, no guarantees because any individual advisor can deliver very little value or a ton of value, but those are some staggering numbers. And while not guaranteed by any means, that's obviously a nice return on investments for consumers if they choose to delegate, and of course, if the advisor can actually deliver. So what we'd like to do now is specifically review each one of these measurements in detail. So first, controlling investment cost, which, as I outlined before, can vary significantly and is one of the invisible costs for an end consumer. Industry leaders in these studies actually published that they would expect around 0.3% per year that an advisor can add to value each year from controlling investment costs. And there's really three keys to this. First, using academic or rules-based investments. This instead of selecting individual fund managers that attempt to beat the market by predicting when the market might go up or down, or frankly, which companies will perform best going forward. Second, hiring advisors to have large enough scale to get bulk discounts or volume discounts on individual investments. This is what we call institutional pricing. And typically it takes anywhere between 50 million and 250 million of any investment in one fund to gain the cheapest share class on mutual funds. And third, maintaining discipline. Sarah's going to get back into this a little further later on, but discipline on the advisory side is incredibly important. Sometimes advisors are paid for the number of trades placed. This is what's called a portfolio churn. This can lead to large trading investment costs, obviously significant tax consequence, and it can hurt portfolio return the consumer would keep. So let's review a chart to put some of this perspective into this issue. So a lot going on here, but this is a display of different mutual fund rates of return over a 10-year time period. And this study was done most recently through the summertime of 2020. Now, as I mentioned in the last slide, typically high-cost funds are more expensive because they employ managers that believe they can beat the market consistently, whereas low-cost funds typically follow more academic methods and many times try to just mimic simple index or a collection of investments. So in the bar chart above, you actually see that the blue indexes, for example, the S&P 500 for US large companies in this slide, those are the benchmarks which funds are often measured against. And the actual difference in realized rates of return over this decade were pretty significantly different between the average high cost and average low cost fund in each category. What's also interesting about this chart is that the difference in rates of return between high cost and low cost funds isn't the exact same as the difference between the actual average cost differences in the charts below. For example, the difference between the average high expense and low expense fund in the US large cap category is about 1.2% per year. The realized return difference was actually double, 2.4% per year, meaning although you would buy a high cost fund in hopes of finding a manager that can predict the market and outperform more low cost funds, the return dragged even more than the cost. So this is why advisors that use more efficient cost funds that have more academic rigor can actually add more value. They simply take the guesswork away and obviously the higher risk for potential for different outcomes out of consideration. Next, let's review the concept of rebalancing. Industry leaders would suggest that following a disciplined rebalancing process can add anywhere between 0.05% and 0.32% additional value per year over time. So what exactly is it? Well, simply, it's the process of buying at relative lows and selling at relative highs. It's not exactly getting out at the wrong time or in at the right time. There's a lot more math and algorithmic approach to this process, and it usually involves setting asset allocation targets and managing to those actual targets set on a consistent basis. Many company retirement plans allow for occasional rebalancing, like quarterly or semi-annually, but usually a more consistent rebalancing process improves on this because it's based on the actual targets, which can be more relevant than a process that is just time bound, because after all, the market moves every day. So let's review a graphic to make sense of this and why it actually adds value. Now, this is obviously a very long time period for those of you looking. It begins back in 1973 and it carries through the end of 2020. Now, if an individual investor started with a portfolio of 60% stocks and 40% bonds, or a 60-40 portfolio on the chart, back in January of 1973, if they never rebalanced and they let their allocation drift over time, that mix eventually became a 90% stock, 10% bond portfolio, because over time, stocks perform better than bonds and gradually become heavier weighted in a portfolio. Instead, if the investor simply bought and brought that portfolio back into alignment whenever stocks became more than 5% underweight because of underperformance, or 5% overweight because of overperformance in the portfolio, it would maintain that risk of the portfolio, risk being that it's too aggressive at the wrong time or too conservative at the wrong time, which is an important part of a financial planning process. And that investor would actually be selling stocks at a point when they're doing better than bonds and selling bonds at a point when they're doing better than stocks. And while this kind of sounds a little counterintuitive because you're selling winners and buying back losers, this can actually add real value over time because it controls the risk and it actually increases returns over time, which is aligned with that industry leader study I'd mentioned before. So next, I'd like to invite Sarah into this conversation about more of other tangible metrics and dig further into the income tax considerations within the published studies by Vanguard, Morningstar, and Russell.
Thanks, Jake. As Jake mentioned, we're going to transition into some different topics, specifically around tax savings. And this is where an investment advisor that really has their eye on watching the overall tax situation, both your personal tax situation, your portfolio's tax situation, can again add some really significant value on an annual basis. He already alluded to the low cost funds and watching that. Low turnover is also a component that affects your taxation. So, as Jake said, an investment advisor that's doing regular churning or buying and selling within your portfolio can drive up your overall tax bill without actually, potentially adding return to the bottom line. But we're going to dig into the bottom three listed here. So the first being asset location. And what we mean by asset location is a bucketing approach. So asset location means that you still want a well-diversified portfolio. So let's say, for example, you're in a 70-30 portfolio, so 70% stocks and 30% bonds. There's a variety of different asset classes that you want to have represented in your portfolio, right? You want some bonds in your portfolio, you want some US large cap stocks, you want to invest outside of the US and have international and emerging market stocks. Well, each one of those asset classes kind of has a tax effect to it. Some of them are much more tax friendly than others. And so what asset location means is that you put the assets that are least tax efficient in accounts where you're not paying the tax bill on it on an annual basis. So we'll walk through an example of how you properly asset locate a portfolio. And by the way, the industry studies value this up to about 0.75% a year, 0.75%. So right, we have these three different tax buckets, the first being pre-tax. So think of this like a traditional IRA, a pre-tax 401k. It's something you haven't paid the tax on yet, but when you hit age 72, you're going to have to start taking required minimum distributions out of that account. And so what is most optimal for an account like this is to put things that, aren't as tax friendly to you. So if you want to have bonds in your portfolio, putting them within the pre-tax or tax deferred accounts like this makes the most sense for two different reasons. bonds are very tax inefficient. And so they're generating ordinary income for you. So if you put them within an IRA, you aren't paying tax on the income generated from that investment on an annual basis. The second benefit of doing this is that bonds across, all the different asset classes that you're invested in should be one of your lower, earners over your lifetime, right? Bonds are in your portfolio for stability. We would expect bonds over time to stocks to outperform bonds. And so why you would place a bond within a tax deferred account is, again, eventually if you have to pay required minimum distributions on this account, driving less of the growth into that account where you have to have these forced distributions later on can lessen your tax bill, not only, now, but again, eventually when you hit that age 72. The next bucket would be a taxable bucket. So think of this as an individual account, a joint account, a trust account, anything that you're going to pay or get a 1099 on at the end of the year. So that's the account where you really want to watch the overall tax efficiency. So putting things in there like US large cap stocks, things that are going to pay qualified dividends, things where, if you hold it for more than a year, you're going to have long-term capital gains rates, things that aren't generating as much ongoing income. And if they are generating income, that it's at those more preferential rates. So again, concentrating that taxable account to be as tax efficient as possible. And then lastly, within the Roth bucket, you've already paid tax on that money. That money is going to grow tax deferred and eventually come out tax free. So what's ideal for a bucket like that is to put maybe some of your more volatile assets, things that maybe aren't as tax efficient, but what you would expect to be your highest growth oriented assets over time, right? Why not drive as much growth as possible in an account in which you don't have to pay tax on again? So when you zoom out and you look at your overall portfolio together, you still have a 70-30 portfolio. You still, have an asset allocation that makes sense for your financial situation. But what's under the covers of each one of these buckets is different on purpose. And again, they value this at about 0.75% per year. Another way to kind of talk about why taxes matter. This looks at a Morningstar study, and these are annualized rates of return over the last 10 years, looking at what the actual index returned, what kind of the broader market return is, and then what the effect of taxation was on that return. So we'll go through one of these as an example. So looking at the US small cap space, had an 11%, the actual broad market index had an 11% average annual rate of return. When you look at what the actual funds within that space did, so this includes both actively managed and more passively managed funds, the pre-tax return on those funds was about 9%. So there's already a spread from where we were, the index returns are similar to what Jake was discussing as, there can be a drag on your portfolio depending on, the types of investments that you choose. But what we're illustrating here is the taxation drag. And so, post-tax, you've lost another 2%, right? So a lot of the return in which you're getting from that investment is being taxed away. So being really cognizant of not only what types of investments you have, but how are the actual tax savings, going to be, given that bucketing approach or given the types of asset you have. That's what an investment advisor can help you implement. Another factor that an investment advisor can help implement for you is something called tax loss harvesting. And so this is a strategy that is valued up to about 0.25% per year. This is only relevant to people that have taxable investment accounts, the only type of account that you can do tax loss harvesting on. But I'll walk you through an example of what that might look like. So scenario one on the left-hand side here, no tax loss harvesting. So think of this as, maybe what you're doing on your own. You start with a $20,000 investment, and right, the market's volatile. It has pullbacks, right? We'll call this COVID. The market pulls back. You started with $20,000. You now lost about $6,000. So you're at $14,000. And let's say, you're a good prudent investor, you should buy and hold. And so you just rode it back up, right? You rode the $6,000 back up. And now at the end of that market volatility, you're back up at $20,000. That doesn't sound like a bad situation, but there's actually something that, by being a little bit more tactical or taking action during those periods of market volatility where, you can add value to the bottom line. So on the right-hand side, we'll illustrate what tax loss harvesting means. So similar situation, right? We start with $20,000. The market has a pullback, but instead of just letting it ride out, what you're doing is you're actually selling the position that you're in, and you're buying an almost identical, but not exactly identical. You have to be cognizant of what's called the IRS wash sales rule to not violate that. So you can't go back into the same investment that you just sold out of, but you can capture something that's very close, because we're not market timers, right? You don't want to be a market timer and say, I don't want to be invested. So you move from mutual fund A over to mutual fund B. And what you've done by doing that is capture that $6,000 loss. And so you stayed invested. So when the markets recover, you are going to ride that back up and be made whole with your $20,000 investment. But by capturing that $6,000 loss, what you can do is you can take up to $3,000 a year off of your ordinary income with those capital losses, or you can use that to offset other future capital gains. So by doing that particular move, you're able to save about $900 in tax. Again, you were made whole on your investments, but you have a reduced tax bill by being strategic during periods of market volatility. Another big area in which an advisor can add value is distribution planning, right? So as somebody who's saving towards their retirement, you've done all the hard work of building up all of these different buckets. And now there's the decisions that need to be made as you enter retirement of how am I going to start taking distributions back out of my investment accounts. And so a lot of people sitting there in retirement saying, well, I have taxable money, I have Roth money, I have pre-tax money. When should I take a certain amount out of on a monthly basis? If I need, $5,000 a month, should I take it all from the IRA? Should I take it all from my taxable account and leave my IRA until I have to take those required minimum distributions? So there's actually strategic tax planning that can go on, given your situation and how long you retired before you start Social Security. There can be a really nice window of opportunity to take advantage of low tax rates. So what we're showing here is a particular situation where the individual retired in 2021. So they had wages in 2021. That's the purple part of your bar chart here. And their wages were actually low enough that in this situation, and given where they were projected to be long-term, taking advantage of being in a lower tax rate. So, they still had plenty of room in the 22% bracket. And down the road, if they're projected to be in a higher tax bracket, maybe it makes more sense to, instead of waiting on taking any tax deferred money out until 72, maybe we should be doing Roth conversions. And so modeling out, again, the distribution plan, right? How do I draw that money back out? Knowing more about, what the current tax rates are, looking just broadly, where we know we're in a low tax rate environment right now, starting to make those strategic decisions and not just looking at each year in isolation, but looking at your long-term plan. Because as you can see in 2025, this client was going to start taking Social Security. And so we had, there's a shorter window in which you can, essentially do higher amounts of Roth conversions. So having somebody lead you through that process and have a good understanding of the tax law can be beneficial. Another quick example here in terms of distribution planning, say, for example, you retire at age 60, you need to find private health insurance before you qualify for Medicare. So you have the option of going and getting subsidized healthcare, right? The lower your income is, the more subsidies you'll get through the ACA or the Affordable Care Act. And so there's, decisions that need to be made. Should I keep my income low and qualify for those subsidies and keep my healthcare costs low? Or should I take advantage of the low tax rate environment that we're in and maybe ignore the subsidies, right? Choose to pay higher amounts for my healthcare, but take advantage again of doing some maybe larger Roth conversions during that time period. And so what this is showing is a particular situation where trying to decide between those, and then what is the actual value of that advice, right? By changing the plan versus, somebody that defaults to wanting to do the Affordable Care Act credits on the left-hand side or saving on the healthcare on the front end, their ending balances after tax were about 1.74 million. All the way on the right-hand side, this is a situation where they instead ignored the subsidies and did really large Roth conversions, maxed out the top of the 22% bracket. As you can see, much more of their overall net worth was now locked into that tax-free bucket. And so ending balances after tax was about $200,000 more, by implementing these strategies. So that just starts to articulate some of the benefit that you can see from distribution planning. Based on the various studies, it ranges anywhere from 0% if you only have one bucket to pull from, but if you start to have more of those buckets and looking at the different planning opportunities, valued anywhere up to about 1.1% annually. One of the largest items that you'll see from these studies, or where they say an investment advisor can really add value, is the behavioral coaching component of it. And what they mean by that is that money's emotional, right? We all live in this 24-hour news cycle. We all have friends and family that get worried about the markets, and so it's really hard to ignore the noise in the market. It's hard to ignore, hey, markets are at new highs. Should I invest my money? And trying to time the market essentially. And so what we see is this tends to be the biggest drag on people's overall investment portfolios. There's actually a study done by Dalbar looking at the 20 years. So this study ended at the end of 2019, so the prior 20 years from that, and looked at various market indices and what did the actual index return do during that time period versus what did investors actually get in terms of market return. And what we're showing here is, again, let's look at the US large cap, for example. The index actually had an average annual return of 7.2%, but investors only got about 5.3% of that. So, thinking about people trying to market time, buying and selling regularly, they're not actually keeping a lot of what the market is returning. And so having an advisor that can lead you through that process and kind of keep you steady and keep knowing your own financial plan and keeping you on course can be a huge value. Fixed income space is even bigger spread. The index did 5% and the average investor only kept about 0.4%. And we're adding inflation in here because we all know that your real return is what you can garner above and beyond inflation. And so, right, you've got to do better than that to actually truly keep return in your pocket at the end of the day. So having, again, somebody be able to help navigate that can be really beneficial. And then market timing, right? This is the big part of behavioral coaching and making sure that you stay the course, because there always is going to be, somebody saying, the markets are going to crash and things like that. So what this study actually looks at is starting with 1990, if you were to put your money in the S&P 500 and just stay invested, so you didn't change course, you stayed invested in the S&P 500, a buy and hold strategy would have yielded you a 10.5% average annual rate of return. When we compare that to somebody that was trying to market time, in this example, the market timing strategy was, hey, the market's off 5%, I'm selling out, right? I'm nervous, I want to get out, I think it's going down further, let's sell and let's wait until the bottom and we'll get right back in. In this situation, again, they sell out at 5% and they actually get back in when the markets come back up 3% from the bottom. So not bad timing, in the grand scheme of things. A lot of people actually wait much longer than this and they want to see more market recovery before they actually get back in. So I think this is being somewhat generous in terms of what actual investors do. But you can see the market timing strategy only got 8.1%. So the staying the course and staying invested is what yields you, good long-term returns. And sometimes that takes having, a trusted advisor to be able to lead you through market volatility, which is something that's consistent and a constant, I guess, within the market.
Thanks, Sarah. I mean, it's a lot of intricate, tax details and investment details that get included in that study, but obviously they can be really significant numbers. So we wanted to flash this graphic back on the screen again because it concludes the review of all of those data-driven, more quantifiable metrics these studies provided some actual data behind. So hopefully this review gave you a really good demonstration on how various financial advisors actually deliver value to consumers. And it actually gives hopefully a greater understanding of how you might value your financial advisor moving forward. And I can tell you from, having worked in this space for a long time, Savant has come to the understanding that there are some other considerations that aren't necessarily shown in this graphic that we hear regularly from clients, and just having from some experience as well. One of them is more quantifiable, and one's, a couple are not. But we'd like to at least, talk a little bit further about those details. But again, in summary here, these three studies would suggest, just based on a lot of these more portfolio driven and tax driven considerations, that an advisor's value somewhere between 2 and 5% as additional value that you get per year beyond, otherwise what you might be doing yourself. So the one quantifiable metric we want to spend some additional time on is time. They don't make more of it. We won't be extending to a 25-hour workday or clock anytime soon. And of course, no one would expect individual consumers to track their own time as they self-advise. We know it can be quite time consuming, especially equal to what more of a typical advisor or advisory firm might spend making various evaluations for clients. So we thought we'd point out a few more recent relevant examples for consideration. The first is both income tax and estate tax law changes. Just in the last 5 years, there have been 4 major pieces of legislation either passed or proposed. There was the Tax Cuts and Jobs Act in 2017, the Secure Act in 2019, the CARES Act in March 2020, and then most recently, the Build Back Better proposal. Now, just these 4 passages of legislation or proposals accounted for more than 3,000 pages of law that needed to be vetted, interpreted, and ultimately planned for, because some had some pretty extenuating circumstances that could impact individual investors. And that's a significant amount of time for any one person to spend to stay current with how actual laws may impact any major financial decisions for a personal financial plan. So obviously, time spent on that category can be quite large, but again, no one expects anyone to quantify that. Secondary to this would be staying current with market trends. Every day, there's a new market, a new product, or an innovation in financial services. And most of them are garbage. This doesn't mean that every new option gets added to a typical portfolio, but it does mean that a changing market warrants a review process to see if updates are needed. Since predicting any one day, 1 month, or 1 year market is nearly impossible, having a 10 to 15 year forward-looking perspective is really important with helping to specifically shape and adapt an investment portfolio. It takes time for professionals to vet these options, and time most consumers aren't willing to spend because they'd frankly rather enjoy moments with their family or in their day-to-day life instead. Cryptocurrency is a great example of something here more recently. Digital currencies are seemingly in the news all the time, and warranting whether or not they're in a portfolio or not, it takes a lot of time, expertise, and care to make that decision. And then there's administering the estate of a loved one. Lots of people have experienced this, and unfortunately, financial and legal services don't make this a really easy process. Grief is already a really difficult journey, and actually navigating this journey while trying to determine if a final income tax return needs to be prepared, or if a trust is being interpreted properly, or frankly, confirming the method in which funds will get to the next generation can be really tiring and burdensome. And it can often take weeks, if not months, to actually get through that process. And something that I would contend that our industry does very poorly in total, because there's a lot there, and it's tough to deal with that, along with kind of the emotions of navigating, an estate plan for a loved one. And finally, there's intangible metrics. These really can't be measured. In fact, it's probably impossible to measure. But as advisors, we consistently hear these are some of the main reasons any individual consumer would enlist the help of qualified advice. Advisors that maintain an open door policy for working through what we'd call critical financial events, such as maybe children facing hardship or a divorce between 2 spouses. Advisors that can help navigate this process can really be priceless. And while it may be the first time someone is divorcing, for example, chances are the advisor has seen divorce many times, and it can help provide wisdom and counseling to that process, coordinating with both spouses and the attorneys for ultimately a better outcome. Advisors can also help really distill priorities and values for a family and uniquely align these with a financial plan. And then down the road, serve as a consistent voice for any major financial or life decisions, having more of a guiding light responsibility. And ultimately, this can lead to oftentimes a higher level of confidence in the future. And of course, what we all strive for in life with any decision we make is peace of mind. So this really concludes our summary of all both the intangible and the tangible ways you can measure value of financial advice. We really hope this helped kind of arm you with the data to make good decisions about any hiring decision that you need to make, whether you're currently retiring, retaining advisory services, or if you're looking to make the decision in the future. And I'd like to pass the conversation back to Sarah now. She helps to outline a tool that Savant actually has developed to bring that value conversation to life in more of an evaluation tool.
Thanks, Jake. As Jake mentioned, we do have a proprietary tool that we have. We call it our investment analysis. And what that tool allows us to do is actually take into account everything that you're doing currently. So what we hear a lot of times is, I have investment accounts all over the place. I have old 401ks. I've got, accounts in a variety of different places. And I don't have a really firm grasp on, what my overall investment portfolio looks like. So what this tool does is it allows us to essentially give you more information and for you to understand really what your overall investment portfolio looks like when you pull it all together. And so again, what we're showing here on the screen is, analyzing your current portfolio. So on the left-hand side, this is what you'd actually see. You be able to glean some really quick tidbits that, hey, I'm sitting on 13.7% of my overall assets are sitting in cash. Did I know that? Is that something that, makes the most sense for me? Again, just giving you a better picture of what your overall portfolio looks like. And one of the things that a lot of people struggle with is to really understand what the actual cost of the current advice that they're getting. Maybe you're doing it yourself and you've picked a variety of mutual funds or ETFs, but you don't really know what the all-in cost is, again, of what you're doing. Or let's say, again, money's in 401ks and you have an outside advisor, that's charging, fees on that. What does it look like for my overall picture? And how much am I currently paying in fees? Not only maybe as a management fee, but what are the actual underlying costs of the funds that I'm in? And so this investment analysis allows us to essentially pull back the covers and look as to, what are the true costs of the investment portfolio that I have today. And then, then you can start asking yourself those questions as to, are there things where, maybe I could get additional value by having somebody help with this, or, with the person I'm currently working with, am I, getting these things? Am I getting the true value of the advice that I'm currently receiving? So again, looking at not only the fund expenses, maybe it's something that you've been worried about is how much the actual trading costs that you're seeing within the portfolio, starting to quantify that and just, again, arming you with more information about your current overall structure of your portfolio so you can have a better understanding of what it looks like today. And what we're able to do in this analysis is actually, again, look at your current portfolio, analyze the expenses, analyze the asset allocation. We get really in the weeds and can even, talk about the specifics of how much do you have invested in value stocks. It gets really detailed. But what it then allows us to do is, again, give you feedback about what is the actual risk return profile of your current investment portfolio, right? What's the measurement of risk? What would be the expected forward-looking return on the asset classes that you're invested in? And how does that compare to, in our investment analysis, obviously we're comparing it to the Savant model portfolios, but it at least gives you a understanding of, net of the fees that you're currently paying versus, net of another investment advisor's fees, is there actual value that could be delivered purely on the investment side? So this, again, is just another tool that we've developed to help answer some of those questions about, what am I paying? What does my overall portfolio look like? So it's a nice tool that we, again, use a lot. And I think, across the board, people learn a lot by looking at their portfolio through this lens, a very analytical lens. They're armed with more information.
And I'd agree with that as well. I think when it comes to analysis like this, when you're trying to identify costs of what you have, I think it's only with the cost of what you have can you really ascertain the value you ultimately receive, because those two go hand in hand. And we'd love, obviously, the opportunity to entertain questions, the group that's participating has, either about this process or generally about advisor value in its context. because this is obviously a pretty important topic. And, as a firm, we have a core value of lifelong learning. So for us to be able to provide an amount of education relevant to this process to help people make good decisions, that's, a key tenet of what we do.
We have had some questions come in, and if you have any additional questions, please feel free to use the Q&A button on your screen so we can make sure to answer those as well. But we'll kick in with the questions that we have. A question came in: what is the name of this proprietary tool? We call it the Savant investment analysis. So this is something that's available to run, on your current portfolio to give you that feedback if you're looking for that.
And I see another one here, compared to exactly how does this, tool run? What is needed to do this process? Typically it's a listing of statements of holdings and values, for each individual account someone may have. And the types of accounts make sense as well for some of the things Sarah mentioned with regards to asset location, determining which assets are owned within each bucket. But typically it's a listing of accounts with the various holdings and the values that are contained within them is what's needed to run an analysis like that. And I also see another one here, relevant to kind of that landscape of financial services professionals. Is there a place where you can find more about RIAs, or how you go best about finding an RIA in the industry, Sarah?
There's a lot of different ways in which you can do kind of broad research, and looking online, there's a website called NAPFA, which allows you to look for fee-only financial advisors. So just doing your research ahead of time is always really important. More and more information is obviously available out there. And just, again, trying to dig under the covers and understand what you're doing currently, and then doing some comparing and contrasting is always a good place to start. We do have some other questions coming in, specifically about, what if you have religious concerns in reference to the investments in which you invest? Are you able to take this into consideration with a portfolio? Here at Savant, we do have the ability to actually tailor the portfolio for specific concerns. So if that's something that you're interested in, we'd be happy to share more information about what that looks like. We have two what we call tilts to the portfolios. One is, more of the social moral tilt, and then one is more of a sustainability, or what you'd consider an ESG type portfolio. So there are some sub choices that you have within our investment portfolios.
I also see another question relevant to the types of experiences advisors may have. We referenced during the your time section the sheer number of legal aspects that can change someone's plans. And so the question is, what type of advisor is able to, analyze some of those different legal and tax implications as they're helping to advise clients? I would suggest that not all firms have the capability to do that. Usually a firm that has, kind of a deep bench of specialists in different skill sets, maybe some attorneys or accountants that are on staff, accountant and advisory staff as well, would be probably more well equipped to have a better pulse on some of the legal updates and challenges that we face on a day in, day out basis, because like any one person, any one advisor can often struggle to keep up with those data points as well.
And we have another question that came in about, Savant is a big believer in broad-based index funds. How does Savant add value in context where an individual investor can buy a low-cost broad-based index fund from a firm like Vanguard or Fidelity? Yes, we are huge believers in index funds. Beyond just choosing the actual index funds, where an investment advisor like Savant can add value are some of those, again, the bucketing approach or the asset location approach that we talked about, some of the tax planning approaches that we talked about as well, and also in terms of the behavioral coaching. So it is much more beyond just picking, a few index funds. Again, we're big believers in the index funds, and we think the costs matter, right? How much you're actually paying for the underlying costs of those particular funds. And what we've seen from research is that those index funds, perform better over the long run than some of those actively managed. So as what Jake outlined, that costs matter of the underlying funds, but also there's a lot of other factors that an advisor can implement beyond just picking, the broad-based indices to provide that value. Another question came in asking about, can you do something similar for other areas of financial plan? I'm assuming this is in reference to, can we quantify specifically, or is there analysis, about other areas of financial planning? That is very customized, right? From the investment side, we're able to take in a lot of the data and analyze it because we have really good information about what you're currently paying. And we're able to, there's a lot more data points associated with analyzing an investment portfolio. When you talk about the quantifiable areas of financial planning, it is going to be very specific to your situation, right? Somebody that has all of those three different buckets, they're going to see a lot of the value from the asset location. Somebody that, only has pre-tax accounts isn't going to see as much of that value. If you've got really large taxable investment accounts, that tax loss harvesting could be really important. So it is going to be really particular to your situation. And so hopefully today helped outline what those different areas are, and so that you at least have a better idea of what might apply to you. Another one just came in here, and this is a broad question, but we'll try to tackle it here. So what are the key differences that make Savant the best choice as an advisor? I mean, what we are here to do today is just to explain what the marketplace looks like and talk about some of the areas in which, an investment advisor can add value. That all of the things that we discussed today, where it's quantifiable, are things that we are able to implement for our clients, including the asset location. So finding somebody that is being cognizant of all of these things that can add that quantifiable value, finding somebody that is able to help you build the financial plan and give you that peace of mind, some of those more intangible aspects. And then somebody that's really staying on top of all of those tax law changes and the estate tax changes. I think having that deep bench and those in-house experts can really change the way in which you are given advice. And that just takes a lot of people to stay on top of. So those are some of the aspects that I'd consider as you're thinking about, the variety of choices that are out there.
And I'd add to that and would contend that with any decision to hire a financial advisor, we're obviously biased, but the relationship is really important that you have with the actual individual advisor that you hire. You have to like the person you work with. But on top of that, it should just be based on relationship. I would start with the bare bones, having someone that is a fiduciary, always working in your best interest, held to that legal standard, not just saying that they're working in your best interest, and generally working with someone that is fee only because they're only paid by you, aligns your interest with theirs. So at a bare minimum, relationship being important, you should also factor in fee only and fiduciary as a key part of that, discerning quality when looking to hire advice. And generally, those are the types of advisors you actually gain the most value from over time as well, because they're always trying to look out for things that are in your best interest to help you, grow within your life and financial plan.
And somebody was asking, what is the total of all the quantifiable pieces related to advice across the various studies? It's anywhere from 2.1% all the way up to about 5%. So Jake mentioned that there were 3 different studies. If you're interested in going and learning more about those studies, the first one that did this was Vanguard, and the actual white paper is called Advisor Alpha. So, again, if you like to dig into details, that's the name of the study, and you're able to read the full white paper. What we did today was just summarize the takeaways from that study. Okay, thank you all for being here today. We really appreciate all of your questions. If we didn't answer your question, or if you have additional questions, make sure to include that in the Q&A. We'll make sure to follow up with you after the fact. Thanks again for being here.